Hi, here we are at Risk Minds USA 2011 in Boston. I'm joined here by Martyn Hoccom, Head of Strategy at RBS Treasury, and Martyn is going to give us a talk tomorrow, and he's here to give us a few of the highlights.
Okay, well, thank you very much for the introduction. Yeah, my talk tomorrow is going to be about living wills, and it's really the next stage of the planning that banks are having to go through to accommodate the new world, where it's quite clear now that governments have decided they don't want to ever be in the position again where they have to recapitalise banks, or that when banks fail they threaten the financial system. I was going to call this talk Basel III What Next? And the reason for that is that, in a sense, what Basel III does is addresses the vulnerabilities of capital and of liquidity. And so it really strengthens the resources of the bank, and it decreases the probability a bank will default, and it decreases, hopefully, the loss at default. But of course, beyond that, it's still possible that a future crisis may overwhelm the resources that even Basel III calls for. And living wills are all about trying to provide an orderly recovery and resolution plan. And in the context of the UK, it's also tied up with the work being done by the Independent Commission on Banking, appointed by the government to make the structure of UK banking safer. And really, to surmise this talk, it's about understanding how banks can plan ahead and structure themselves legally and operationally, so that in the event of a major stress event, they've already got plans in place that will enable them to, in an orderly fashion, allow the bank to break up, to sell key components of the bank, to identify up front what the key critical economic functions of the bank are. That's particularly around payment systems, depositors, so that those activities can be easily disaggregated from a failing bank and protected, and either given to a regulator or enable another bank to take over those functions. So
this is the ring-fence type of agreement, similar to what the FDIC has in the US.
That's right, yeah. And the Commission in the UK are looking at evidence from people like the FDIC and what the European Commission are proposing around living wills and recovery plans. And I think it's really based around two major concepts. One is to have a lot more loss-absorbing capacity in the system. If you think about it, the last crisis, it really was only equity that absorbed losses. What we're going to have now is that all capital will be loss-absorbing, plus CoCos, plus potentially the ability to bail in debt, so that there's a very, very deep layer and cover of liabilities that can cover losses without resort to the taxpayer, and that enable the institution to continue trading through a crisis. And then secondly, as you said, like with the FDIC, that there's an operational capability to move the operations of such an institution into a safer place, so that an institution, even large institutions, universal banks in the European model, can find a way to resolve themselves without threatening either taxpayers or the financial system more widely.
So I have a couple of questions. So first, you mentioned CoCos, and the Swiss regulator came up with a few guidelines.
Yeah.
With, I think, trigger points at a capital level of 7%, if I'm not mistaken.
Right. Yeah.
So what are your feelings about that, and do you have in mind an optimal trigger point? Do you think that there should be flexible trigger points? What are your thoughts on this?
I think the evolving here has evolved somewhat, and I think that when we look at CoCos, we're really now seeing them as being part of a recovery plan, and for that reason, I think that CoCos probably should be struck at higher triggers against capital, more towards the 7-8% level. And the reason I say that is that because, if the Basel minimum is around 7, as we're going to find it in the future, and with SIFI surcharges and so on, I expect that global banks will be running along on 9-10%. As they dip into that capital, that should be feasible for them to carry on trading. If it falls below 7, I think the markets will get so concerned that it expects some action, so that would be an appropriate trigger to recapitalise with CoCos. The very low trigger CoCos that some banks have looked at I think are going to be more problematic, because I think once you dip below 4%, say if that was a trigger, once you dip below 4%, you're really into resolution territory. And then what value is it having cocos to recapitalise if the possibility of recovering the bank is so low?
Of course.
So I think cocos are interesting. I think they will play a part in the future financial regulatory landscape. I think that one of the issues that we're going to have to face with cocos, and the way we manage this with the markets, is that the cocoa triggers don't become seen as a signal of distress. Because if they're seen as a signal of distress that then stops the markets providing liquidity to a particular player,
cutting off the liquidity line,
then we've solved one problem, but
creating another one. Absolutely,
that's the difficulty. And I think cocos, they do have issues around them, but I think that we need to find ways to make it work. And I think that having high trigger cocos is part of the solution.
Okay, very good. Concerning the so-called living wills.
Yeah.
Regulators obviously like the idea quite a lot, because in our minds it eliminates a lot of the moral hazard by eliminating the possibility of a government takeover of the bank or any kind of a government intervention. The question I had for you is the whole scheme basically relies on the credibility of the living will and on the fact that the market will believe that, push come to shove, the living will be acted upon. And when it comes to very large international banks that have a presence in multiple jurisdictions, isn't there a risk that you have this beautiful document that explains in detail what you think you will do when the time comes for you to die?
Yeah, I think it's a major, we're really in new territory. I think it's a major challenge. I think it's a major challenge even for a domestic bank to arrange itself and to have a living will.
But at least you have one jurisdiction to deal with.
At least you would have one jurisdiction. I think that the point you raise around global entities, it's going to require, I think, the biggest piece of integration of regulation and company law across the whole of the Basel world that we've ever seen before. So it will require that regulators, the College of Regulators, are very, very tightly integrated. That if we ever get into this situation, there's a commonality of understanding about how claims will be handled, how the different classes of creditors will be treated in any resolution regime without any national grabbing of particular assets within a particular jurisdiction. I think that's very, very difficult to achieve, and I think it's one of the major challenges of this process. But I think that what we need to do as an industry is to come forward with these ideas, challenge ourselves and challenge our supervisors and regulators, lay out the issues so that we start to solve these problems. It's like the Chinese proverb, a journey of 10,000 miles begins with the first step, and I think we're in the first steps of this, but there will be major challenges. You're absolutely right.
Good. Well, Martyn, thank you very much, and looking forward for your talk.
Welcome. Thank you very much.
Bye-bye.